Norway's sovereign wealth fund just took a massive hit, losing about 40 billion in the first quarter, primarily because US tech stocks took a dive. It's kind of like having a giant ship that suddenly gets hit by a rogue wave, you know?
Wow, that's a serious dent in the fund. So essentially, their big exposure to US tech really came back to bite them, right?
Exactly. The fund, which is worth roughly $1.7 trillion, is heavily index driven. It's largely following the FTSE Global All Cap Index that gives around 65% weight to North American companies. When those tech stocks stumble, the impact is enormous.
And on top of that, they've got this indirect exposure to Bitcoin too, don't they? I read that they kind of hold around 3,821 BTC through their stock picks.
Yep, that's right. While they're not directly buying Bitcoin, their investments in companies like Coinbase and Riot platforms bump up their indirect Bitcoin holding to roughly a $356 million exposure.
Yeah.
That could lead to some sell pressure risk if things shift in the crypto market.
So given this situation, there's been a debate. Might they hedge this tech risk by increasing their Bitcoin exposure? Seems counterintuitive with Bitcoin's volatile reputation though, doesn't it?
That's the million-dollar question, isn't it? On one side, Bitcoin is seen as a hedge, especially during global trade tensions or looming recession fears. But then technically, the fund's mandate hasn't really allowed for a direct buy into something like a spot Bitcoin ETF, especially since they ditched gold decades ago.
Right. Yeah, the gold angle is interesting too. They sold off all their gold by early 2004 because it wasn't performing as well then. But looking back now, gold has outperformed the S&P 500 by a huge margin.
Exactly. It's like selling a winning lottery ticket because you didn't realize its potential value at the time. Now, they're heavily into equities, about 71.4% of their portfolio. And with such massive exposure to stock markets, even a slight downturn can be catastrophic.
Yeah, I see that. And with US tech stocks plummeting, it shows just how brittle that concentration can be. So then the idea arises. Should the fund pivot more towards Bitcoin or crypto-related investments as a hedge?
That's exactly the debate. There are precedents too. Abu Dhabi's sovereign fund and even the state of Wisconsin have taken stances by investing in Bitcoin ETFs or crypto companies. It's essentially a method to diversify against shocks in traditional markets. But honestly, it's not a simple swap, is it?
No, it's definitely tricky. On one hand, more exposure to Bitcoin might help offset tech downturns. But on the other, Bitcoin's inherent volatility is unpredictable. It's like trying to balance on a very wobbly tightrope.
Right, and that's exactly the risk. Increasing direct Bitcoin exposure could bring in a hedge against certain economic uncertainties, such as a global trade war or a recession, but then you're also opening the door to crypto's notorious ups and downs.
Yeah, and there's also the risk of mass sell-offs. Imagine if, due to market stress, the fund had to liquidate some of its Bitcoin-linked assets. That could ripple through the market even further.
Yes, that's a very valid concern. It's like a chain reaction. You move to hedge one risk, and then inadvertently, you might amplify another. Plus, even the indirect exposure, a mere $356 million, is small relative to their total portfolio.
I know what you mean, but even a tiny percentage of such a massive portfolio can have somewhat outsized effects in the crypto space. It's a bit of a paradox, isn't it?
It really is. And then there's their current strategy, where CEO Nikolai Tangen mentioned increasing investments in US stocks. It's like they're doubling down on familiar territory, even after such a significant loss.
That seems contradictory. If tech stocks are causing so many issues, why not pivot more decisively into alternative assets like Bitcoin?
I actually respectfully challenge that point a bit. Doubling down on US stocks might be seen as safe because they've generated huge profits in the past, like the $222 billion in 2024, but it clearly leaves them vulnerable when tech takes a hit. There's a delicate balance here.
So, could we say that a diversified approach is the best bet right now? Keeping a mix of equities, a cautious nod to crypto exposure, and other asset classes like real estate?
Exactly. Real estate, for instance, forms another pillar in their investments, spanning retail, industrial, renewable energy, and logistics globally. That diversification helps mitigate the concentrated risks in tech. It's all about
Yep.
layering your exposures.
And in a global trade war scenario or looming recession, that mix might be the only way to stay somewhat insulated.
For sure, it really underlines the point that no single hedge is a magic solution. Whether it's tech, crypto, or real estate, each asset class brings its own set of risks and rewards.
What's interesting too is that a hypothetical allocation as low as 5% in Bitcoin back in 2018 could have dramatically boosted their benchmark performance. That makes you wonder about the missed opportunities.
Definitely, it's like missing out on a secret ingredient in a well-known recipe. However, I wonder if they'd ever be willing to further adjust their strategy given their strict mandates.
Yeah, I get that. Right, change in mandate is no small feat, especially for something as well established as a sovereign wealth fund. I mean, it's not like they can just flip a switch and start piling into a Bitcoin ETF.
Exactly. They're more likely to consider increasing exposure through companies heavily involved in crypto rather than direct purchases, which is exactly what they've been doing with stocks like Coinbase.
Yeah, so in summary, it's a sort of double-edged sword. Tech and crypto both offer high rewards, but come with equally high risks. That $40 billion loss is a stark reminder of how fast fortunes can change.
Yep, you nailed it. It's like a high-stakes balancing act. Too much concentration in one area can lead to catastrophic losses, but diversifying into unpredictable realms like crypto also adds its own layer of volatility.
And with the fund being so huge, even minor shifts could have global ripple effects. It's not just about recovering the losses now, but protecting against potential future shocks.
Right. As the global landscape shifts with trade wars, recession worries, and evolving tech trends, the fund's strategy will have to be incredibly nimble.
Exactly.
They're playing a long game here.
So, do you think we'll watch a strategic pivot in the near future, perhaps even a more active stance on crypto?
It's possible, but given the fund's history and mandate constraints, any move towards more crypto involvement will probably be very gradual. Plus, with US stock investments still in focus for now, it appears they're
Right, I
treading
guess.
carefully.
And what about the potential for increasing exposure to companies that hold Bitcoin rather than the cryptocurrency itself? That might offer a middle ground.
That's an intriguing idea, kind of like indirectly dipping your toe into crypto without committing fully to its wild swings. But remember, those companies are still subject to overall market volatility.
Yeah, true. It really is a chess game. Every move seems to have both a protective and a risky angle.
Exactly, a constant balancing act. And with the uncertainties in both the tech and crypto arenas, the fund might continue to hedge its bets by staying diversified across multiple assets.
Yep, all this really underscores the fierce complexity of managing such a massive fund in today's volatile economic climate.
Absolutely, it's a vivid reminder of how global economic tensions and rapid technological shifts can upend even the most established financial orders.
And while the allure of strategic crypto exposure is there, the risks remain significant. It's a fascinating puzzle that'll keep analysts busy for a while.
For sure, at the end of the day, maintaining a smart, diversified portfolio might be the safest route for them, balancing between tech recoveries, crypto hedges, and solid real estate investments.
Yeah, absolutely. It's been a really insightful chat about how a $40 billion setback can ripple through so many dimensions of a fund's strategy. It definitely highlights the complexity of today's global markets.
Absolutely, a dynamic blend of strategy, risk management, and constant evaluation. It's like watching a high-stakes game unfold in real time, and we'll be keeping an eye on how it all plays out.
Right. Thanks for the deep dive today. It's been great discussing these intricate maneuvers with you.
For sure, looking forward to the next discussion on these evolving market trends.